Buffett Partnership Limited, 810 Kiva Plaza, Omaha 31, Nebraska. January 18, 1964. Our performance in 1963. 1963 was a good year. It was not a good year because we had an overall gain of $3,637,167, or 38.7%. On our beginning net assets, pleasant as that experience may be to the pragmatists in our group, rather it was a good year because our performance was substantially better than that of our fundamental yardstick, the Dow Jones Industrial Average, hereinafter called the Dow. If we had been down 20% and the Dow had been down 30%, this letter would still have begun, 1963 was a good year, regardless of whether we are a plus or minus in a particular year. If we can maintain a satisfactory edge on the Dow over an extended period of time, our long-term results will be satisfactory, financially as well as philosophically. To bring the record up to date, the following summarizes the year-by-year performance of the Dow, the performance of the partnership before allocation to the general partner, and the limited partner's results for all full years of BBL's and predecessor partnerships' activities. Year 1957, negative 8.4% overall results from Dow, 10.4% partnership results, 9.3% limited partners results. Year 1958, 38.5% overall results from Dow, 14.9% partnership results, 32.2% limited partners results. Year 1958. Year 1959, 20% overall results from Dow, 25.9% partnership results, 20.9% limited partners results. Year 1960, negative 6.2% overall results from Dow, 22.8% partnership results, 18.6% limited partners results. Year 1961, 22.4% overall results from Dow, 45.9% partnership results, 35.9% limited partners results. Year 1962, negative 7.6% overall results from Dow, 13.9% partnership results, and 11.9% limited partners results. Year 1963, 20.7% overall results from Dow, 38.7% partnership results, and 30.5% limited partners results. For the overall results from Dow, these are based on yearly changes in the value of the Dow plus dividends that would have been received through ownership of the Dow during that year. For the partnership results, 1957 to 61 consists of combined results of all predecessor limited partnerships operating throughout the entire year after all expenses but before distributions to partners or allocations to the general partner. For limited partners results, for 1957 to 61 computed on the basis of the preceding column of partnership results allowing for allocation to the general partner based upon the present partnership agreement. One wag among the limited partners has suggested I add a fourth column showing the results of the general partner. Let's just say he, too, has an edge on the Dow. The following table shows the cumulative or compounded results based on the preceding table. Year 1957, negative 8.4% overall results from Dow, 10.4% partnership results, 9.3% limited partner results. Year 1957 to 58, 26.9% overall results from Dow, 55.6% partnership results, and 44.5% limited partners results. Year 1957 to 59, 52.3% overall results from Dow, 95.9% partnership results, and 74.7% limited partners results. Year 1957 to 1960, 42.9% overall results from Dow, 140.6% partnership results, and 107.2% limited partners results. For year 1957 to 61, 74.9% overall results from Dow, 251% partnership results, and 181.6% limited partners results. Year 1957 to 62, 61.6% overall results from Dow, 299.8% partnership results, and 215.1% limited partners results. For year 1957 to 63, 95.1% overall results from Dow, 454.5% partnership results, and 311.2% limited partners results. With an annual compounded rate of 10% in overall results from Dow, 27.7% partnership results, and 22.3% for limited partners results. It appears that we have completed 7 fat years. With no apologies to Joseph, we shall attempt to ignore the biblical script. I've never gone overboard for Noah's ideas on diversification either. In a more serious vein, I would like to emphasize that, in my judgment, our 17.7 margin over the Dow shown above is unattainable over any long period of time. A 10 percentage point advantage would be a very satisfactory accomplishment, and even a much more modest edge would produce impressive gains, as will be touched upon later. This view, and it has to be guesswork, informed or otherwise, carries with it the corollary that we must accept prolonged periods of much narrower margins over the Dow, as well as at least occasional years when our record will be inferior, perhaps substantially so, to the Dow. Much of the above sermon is reflected in the Crown Rules, sent to everyone in November, but it can stand repetition. Investment companies. We regularly compare our results with the 2 largest open-end investment companies, mutual funds, that follow a policy of being typically 95 to 100% invested in common stocks, and the 2 largest diversified closed-end investment companies. These are companies Massachusetts Investors Trust, Investor Stock Fund, Tricontinental Corporation, and Lehman Corporation manage about $4 billion and are probably typical of most of the $25 billion investment company industry. My opinion is that their results roughly parallel those of the vast majority or other investment advisory organizations which handle, in aggregate, vastly greater sums. The purpose of this tabulation, which is shown below, is to illustrate that the Dow is no pushover as an index or investment achievement. The advisory talent managing just the 4 companies shown commands annual fees of over $7 million, and this represents a very small fraction of the industry. The public batting average of this highly paid talent indicates the achieved results slightly less favorable than the Dow. Both our portfolio and method of operation differ substantially from the investment companies in the table. However, most partners, as an alternative to their interest in the partnership, would probably have their funds invested in immediate producing results comparable with investment companies, and I, therefore, feel they offer a meaningful standard of performance. Yearly results. Year 1957, negative 11.4 Massachusetts Investors Trust, negative 12.4% Investors Stock, negative 11.4% Lehman, negative 2.4% Tricontinental, negative 8.4% Dow, 9.3% Limited Partners. Year 1958, 42.7% Massachusetts Investors Trust, 47.5% Investor Stock, 40.8% Lehman, 33.2% Tricontinental, 38.5% Dow, 32.2% Limited Partners. Year 1959, 9% Massachusetts Investors Trust, 10.3% Investor Stock, 8.1% Lehman, 8.4% Tricontinental, 20% Dow, 20.9% Limited Partners. Year 1960, negative 1% Massachusetts Investors Trust, negative 0.6% Investor Stock, 2.5% Lehman, 2.8% Tricontinental, negative 6.2% Dow, 18.6% Limited Partners. Year 1961, 25.6% Massachusetts Investors Trust, 24.9% Investor Stock, 23.6% Lehman, 22.5% Tricontinental, 22.4% Dow, 35.9% Limited Partners. Year 1962, negative 9.8% Massachusetts Investors Trust, negative 13.4% Investor Stock, negative 14.4% Lehman, negative 10% Tricontinental, negative 7.6% Dow, 11.9% Limited Partners. Year 1963, 20% Massachusetts Investors Trust, 16.5% Investor Stock, 23.8% Lehman, 19.5% Tricontinental, 20.7% Dow, 30.5% Limited Partners. For Massachusetts Investors Trust and Investor Stock, these are computed from changes in asset value plus any distributions to holders of record during year. And for Lehman and Tricontinental, these are from 1963 Moody's Banking Finance Manual for 1957 to 62, estimated for 1963. Compounded. Year 1957, negative 11.4% Massachusetts Investors Trust, negative 12.4% Investor Stock, negative 11.4% Lehman, negative 2.4% Tricontinental, negative 8.4% Dow, 9.3% Limited Partners. Year 1957 to 58, 26.4% Massachusetts Investors Trust, 29.2% Investor Stock, 24.7% Lehman, 30% Tricontinental, 26.9% Dow, 44.5% Limited Partners. Year 1957 to 59, 37.8% Massachusetts Investors Trust, 42.5% Investor Stock, 34.8% Lehman, 40.9% Tricontinental, 52.3% Dow, 74.7% Limited Partners. Year 1957 to 1960, 36.4% Massachusetts Investors Trust, 41.6% Investor Stock, 38.2% Lehman, 44.8% Tricontinental, 42.9% Dow, 107.2% Limited Partners. Year 1957 to 61, 71.3% Massachusetts Investors Trust, 76.9% Investor Stock, 70.8% Lehman, 77.4% Tricontinental, 74.9% Dow, 181.6% Limited Partners. Year 1957 to 1962, 54.5% Massachusetts Investors Trust, 53.2% Investor Stock, 46.2% Lehman, 59.7% Tricontinental, 61.6% Dow, 215.1% Limited Partners. Year 1957 to 63, 85.4%. Massachusetts Investors Trust, 78.5% investor stock, 81% Lehman, 90.8% Tricontinental, 95.1% Dow, 311.2% Limited Partners, with an annual compounded rate of 9.2% for Massachusetts Investors Trust, 8.6% investor stock, 8.8% Lehman, 9.7% Tricontinental, 10% Dow, 22.3% Limited Partners. The Dow, of course, is an unmanaged index, and it may seem strange to the reader to contemplate the high priests of Wall Street striving vainly to surpass or even equal it. However, this is demonstrably the case. Moreover, such a failure cannot be rationalized by the assumption that the investment companies et al. Are handling themselves in a more conservative manner than the Dow. As the table above indicates, and as more extensive studies bear out, the behavior of common stock portfolio managed by this group on average have declined in concert with the Dow. By such a test of behavior in declining markets, our own methods of operation have proven to be considerably more conservative than the common stock component of investment company or investment advisor group. While this has been true in the past, there obviously can be no guarantees about the future. The above may seem like rather strong medicine, but it is offered as a factual presentation and in no way as criticism. Within their institutional framework and handling the many billions of dollars involved, the results achieved are the only ones attainable. To behave unconventionally within this framework is extremely difficult. Therefore, the collective record of such investment media is necessarily tied to the record of corporate America. Their merits, except in the usual case, do not lie in superior results or greater resistance to decline in value. Rather, I feel they earn their keep by the ease of handling, the freedom from decision-making, and the automatic diversification they provide, plus perhaps the most important, the insulation afforded from temptation to practice patently inferior techniques which seem to entice so many would-be investors. The joys of compounding. Now to the pulse-quickening portion of our essay. Last year, in order to drive home the point on compounding, I took a pot shot at Queen Isabella and her financial advisors. You will remember they were euchred into such an obviously low compound situation as the discovery of a new hemisphere. Since the whole subject of compounding has such a crass ring to it, I will attempt to introduce a little class into this discussion by turning to the art world. Francis I of France paid 4,000 incas in 1540 for Leonardo da Vinci's Mona Lisa. On the off chance that a few of you have not kept track of the fluctuations of the IKU, 4,000 converted out to about $20,000. If Francis had kept his feet on the ground and he and all his trustees had been able to find a 6% after-tax investment, the estate now would be worth something over $1 quadrillion. That's 1 quadrillion or 3,000 times the present national debt, all from 6%. I trust this will end all discussion in our household about any purchase or paintings qualifying as an investment. However, as I pointed out last year, there are other morals to be drawn here. One is the wisdom of living a long time. The other impressive factor is the swing produced by relatively small changes in the rate of compound. Below are shown the gains from $100,000 compounded at various rates. 10 years, $48,024 for 4%, $115,892 at 8%, $210,584 at 12%, $341,143 at 16%. 20 years, $119,111 at 4%, $366,094 at 8%, $864,627 at 12%, $1,846,060 at 16%. 30 years, $224,337 at 4%, $906,260 at 8%, $2,895,970 at 12%, $8,484,940 at 16%. It is obvious that a variation of merely a few percentage points has an enormous effect on the success of a compounding investment program. It is also obvious that this effect mushrooms as the period lengthens. If over a meaningful period of time, Buffett partnership can achieve an edge of even a modest number of percentage points over the major investment media, its function will be fulfilled. Some of you may be downcast because I've not included in the above table the rate of 22.3% mentioned on page 3. This rate, of course, is before income taxes, which are paid directly by you, not the partnership. Even excluding this factor, such a calculation would only prove the absurdity of the idea of compounding at very high rates, even with initially modest sums. My opinion is that the Dow is quite unlikely to compound for any important length of time at the rate it has during the past 7 years, and, as mentioned earlier, I believe our margin over the Dow cannot be maintained at its level today. The product of these assumptions would be a materially lower average rate of compound for BPL in the future, and the rate achieved to date injecting a minus 30% per year, which is going to happen from time to time, into our tabulation of actual results to date, with, say, a corresponding minus 40% for the Dow, brings both the figures on the Dow and DPL more in line with longer range possibilities. As the compounding table above suggests, such a lower rate can still provide highly satisfactory long-term investment results. Our method of operation. At this point, I always develop literary schizophrenia. On the one hand, I know that we have in the audience a number of partners to whom details of our business are interesting. We also have a number to whom this whole thing is Greek and who undoubtedly wish I would quit writing and get back to work. To placate both camps, I'm just going to sketch briefly our 3 categories at this point, and those who are interested in getting their doctorate can refer to the appendix for extended treatment of examples. Our 3 investment categories are not differentiated by their expected profitability over an extended period of time. We are hopeful that they will each, over a 10 or 15-year period, produce something like the 10 percentage point margin over the Dow. That is our goal. However, in a given year, they will have violently different behavior characteristics depending primarily on the type of year it turns out to be for the stock market generally. Briefly, this is how they shape up. Generals, a category of generally undervalued stocks determined primarily by quantitative standards, but with considerable attention also paid to the qualitative factor. There is often little or nothing to indicate immediate market improvement. The issues lack glamour or market sponsorship. Their main qualification is a bargain price, that is, an overall valuation on the enterprise substantially below what careful analysis indicates its value to a private owner to be. Again, let me emphasize that while the quantitative comes first and is essential, the qualitative is important. We like good management. We like a decent industry. We like a certain amount of ferment in a previously dormant management or stockholder group, but we demand value. The general group behaves very much in sympathy with the Dow and will turn in a big minus result during the year of substantial decline by the Dow. Contrariwise, it should be the star performer in a strongly advancing market. Over the years, We expected, of course, to achieve a satisfactory margin over the Dow. Workouts. These are the securities with a timetable. They arise from corporate activity, sellouts, mergers, reorganizations, spin-offs, etc. In this category, we are not talking about rumors or inside information pertaining to such developments, but to publicly announced activities of this sort. We wait until we can read it in the paper. The risk pertains not primarily to general market behavior, although that is sometimes tied into a degree, but instead to something upsetting the apple cart so that the expected development does not materialize. Such killjoys could include antitrust or other negative government action, stockholder disapproval, withholding, withholding of tax rulings, etc. The gross profits in many workouts appear quite small. A friend refers to this as getting the last nickel after the other fellow has made the first 95 cents. However, the predictability coupled with a short holding period produces quite decent annual rates of return. This category produces more steady absolute profits from year to year than generals do. In years of market decline, it piles up a big edge for us. During bull markets, it is a drag on performance. On a long-term basis, I expected to achieve the same sort of margin over the Dow attained by generals. Controls. These are rarities, but when they occur, they are likely to be of significant size. Unless we start off with the purchase of a sizable block of stock, controls develop from the general category. They result from situations where a cheap security does nothing price-wise for such an extended period of time that we are able to buy a significant percentage of the company's stock. At that point, we are probably in a position to assume some degree of, or perhaps complete, control of the company's activities. Whether we become active or remain relatively passive at this point depends upon our assessment of the company's future and the management's capabilities. The general we have been buying the most aggressively in recent months possesses excellent management, following policies that appear to make very good sense to us. If our continued buying puts us in a controlling position at some point in the future, we will probably remain very passive regarding the operation or this business. We do not want to get active merely for the sake of being active. Everything else being equal, I would much rather let others do the work. However, when an active role is necessary to optimize the employment of capital, you can be sure we will not be standing in the wings. Active or passive in a control situation, there should be a built-in profit. The sine qua non of this operation is an attractive purchase price. Once control is achieved, the value of our investment is determined by the value of the enterprise, not the oftentimes irrationalities of the marketplace. Our willingness and financial ability to assume a controlling position gives us two-way stretch on many purchases in group of generals. If the market changes its opinion for the better, the security will advance in price. If it doesn't, we will continue to acquire stock until we can look to the business itself rather than the market for vindication of our judgment. Investment results in the control category have to be measured on the basis of at least several years. Proper buying takes time, if indeed strengthening management, redirecting the utilization of capital, perhaps effecting a satisfactory sale or merger, etc., are also all factors that make this business to be measured in years rather than months. For this reason, in controls, we are looking for wide margins of non-profit. If it looks at all close, we pass. Controls in the buying stage move largely in sympathy with the Dow. In the later stages, their behavior is geared more to that of workouts. As I've mentioned in the past, the division of our portfolio among the three categories is largely determined by the accident or availability. Therefore, in a minus year for the Dow, whether we are primarily in generals or workouts is largely a matter of luck. But if we will have a great deal to do with our performance relative to the Dow, this is one or many reasons why a single This is one or many reasons why a single year's performance is of minor importance and, good or bad, should never be taken too seriously. If there is any trend as our assets grow, I would expect it to be toward controls, which heretofore have been our smallest category. I may be wrong in this expectation. A great deal depends, of course, on the future behavior of the market, on which your guess is as good as mine. I have none. At this writing, we have a majority of capital and generals, workouts ranked second, and controls are third. Miscellaneous. We're starting off the year with net assets of $17,454,900. Our rapid increase in assets always raises the question of whether this will result in a dilution of future performance. To date, there is more of a positive than inverse correlation between the size of the partnership and its margin over the Dow. This should not be taken seriously, however. Larger sums may be an advantage at some times and a disadvantage at others. My opinion is that our present portfolio could not be improved if our assets were $1 million or $5 million. Our idea inventory has always seemed to be 10% ahead of our bank account. If that should change, you can count on hearing from me. Susie and I have an investment of $2,392,900 in the partnership. For the first time, I had to withdraw funds in addition to my monthly payments, but it was a choice of this or disappointing the Internal Revenue Service. Susie and I have a few non-marketable, less than 300 holders, securities of normal size left over from earlier years, which in aggregate are worth perhaps 1% of our partnership in interest. In addition, we have one non-marketable holding of more material size, a local company purchased in 1960, which we expect to hold indefinitely. Aside from this, all our eggs are in the BPL basket, and they will continue to be. I can't promise results, but I can promise a common destiny. In addition, that endless stream of relatives of mine consisting of my 3 children, mother, father, 2 sisters, 2 brothers-in-law, father-in-law, 4 aunts, 4 cousins, and 5 nieces and nephews have interests in BPL directly or indirectly totaling $1,247,190. Bill Scott is also in with both feet, having an interest along with his wife or $237,400,000, the large majority or their net worth. Bill has done an excellent job and on several or are more interesting situations. Going into 1964, he has done the majority or the contact work. I have also shoved off on him as much as possible of the administrative work, so if you need anything done or have any questions, don't hesitate to ask for Bill if I'm not around. Beth and Donna have kept an increasing workload flowing in an excellent manner. During December and January, I am sure they wish they had found employment elsewhere, but they always manage to keep a mountain of work shipshape. Pete, Marwick, Mitchell has done their usual excellent job of meeting a tough timetable. We have instructed them to conduct 2 surprise checks a year, rather than 1 as in past years, on our securities, cash, etc. in the future. These are relatively inexpensive, and I think make a good deal of sense in any financial organization. Within the next week, you will receive 1. A tax letter giving you all BPL information needed for your 1963 federal income tax return. This letter is the only item that counts for tax purposes. 2. An audit from Pete, Marwick, Mitchell and Company for 1963, setting forth the operations and financial position for BPL as well as your own capital account. 3. A letter signed by me setting forth the status of your BPL interest on January 1, 1964. This is identical with the figure developed in the audit. 4. Schedule A to the partnership agreement listing all partners. Let me know if anything needs clarifying. As we grow, there is more chance of missing letters, a name skipped over, a figure transposition, etc. So speak up if it appears we might have erred. Our next letter will be about July 15th, summarizing the first half. Cordially, Warren E. Buffett. Appendix. Texas National Petroleum. This situation was a run-of-the-mill workout arising from the number one source of workouts in recent years, the sellouts of oil and gas-producing companies. TNP was a relatively small producer which I had been vaguely familiar for years. Early in 1962, I heard rumors regarding a sellout to Union Oil of California. I never act on such information, but in this case, it was correct and substantially more money would have been made if we had gone in at the rumor stage rather than the announced stage. However, that's somebody else's business, not mine. In early April 1962, the general terms of the deal were announced. TNP had three classes of securities outstanding. 1. 6.5% of shares callable at 104 1/4, which would bear interest until the sale transpired and at the time would be called. There were $6.5 million outstanding, of which we purchased $264,000 principal amount before the sale closed. 2. About 3.7 million shares of common stock, of which the officers and directors owned about 40%. The proxy statement estimated the proceeds from the liquidation would produce $7.42 per share. We purchased 64,035 shares during the 6 months or so between announcement and closing. 3. 650,000 warrants to purchase common stock at $3.50 per share, using the proxy statement estimate of $7.42 for the workout and the common resulted in $3.92 as a workout on the warrants. We were able to buy 83,200 warrants, or about 13% of the entire issue in 6 months. The risk of stockholder disapproval was nil. The deal was negotiated by the controlling stockholders and the price was a good one. Any transaction such as this is subject to title searches, legal opinions, etc. But this risk could also be appraised at virtually nil. There were no antitrust problems. This absence of legal or antitrust problems is not always the case by any means. The only fly in the ointment was the obtaining of the necessary tax ruling. Union Oil was using a standard ABC production of payment method of financing. The University of Southern California was the production payment holder, and there was some delay because of their eleemosynary status. This posed a new problem for the Internal Revenue Service, but we understood USC was willing to waive this status, which still left them with a satisfactory profit after they borrowed all the money from a bank. While getting this ironed out created delay, it did not threaten the deal. When we talked with the company on April 23rd and 24th, their estimate was that the closing would take place in August or September. The proxy material was made May 9th and stated the sale will be consummated during the summer of 1962 and that within a few months thereafter the greater part of the proceeds will be distributed to stockholders in liquidation. As mentioned earlier, the estimate was $7.42 per share. Bill Scott attended the stockholders meeting in Houston on May 29th, where it was stated that they still expected to close on September 1st. Following are excerpts from some of the telephone conversations we had with the company officials in ensuing months. On June 18th, the Secretary stated, Union has been told a favorable IRS ruling has been formulated, but must be passed on by additional IRS people. Still hoping for ruling in July. On July 24th, the President said that he expected the IRS ruling early next week. On August 13th, the treasurer informed us that the TNP, Union Oil, and USC people were all in Washington attempting to thrash out a ruling. On September 18th, the treasurer informed us no news, although the IRS says the ruling could be ready by next week. The estimate on payout was still $7.42. The ruling was received in late September and the sale closed on October 31st. Our bonds were called November 13th. We converted our warrants to common stock shortly thereafter and received payments on the common of $3.50. December 14th, 1962, $3.90, February 4, 1963, and 15 cents on April 24, 1963. We will probably get another 4 cents in a year or two. On 147,235 shares after exercise of warrants, even 4 cents per share is meaningful. This illustrates the usual pattern. 1. The deals take longer than originally projected, and 2. The payouts tend to average a little better than the estimates. With TNP, it took a couple of extra months, and we received a couple of extra percent. The financial results of TNP were as follows. 1. On the bonds, we invested $260,773 and had an average holding period of slightly under 5 months. We received 6.5% interest on our money and realized a capital gain of $14,446. This works out to an overall rate of return approximately 20% per annum. On the stock and warrants, we have realized a capital gain of $89,304, and we have stubs presently valued at $2,946. From an investment of $146,000 in April, our holdings ran to $731,000 in October. Based on the time the money was employed, the rate or return was about 22% per annum. In both cases, the return is computed on an all-equity investment. I definitely feel some borrowed money is warranted against a portfolio of workouts, but feel it is a very dangerous practice against generals. We are not presenting TNP as any earth-shaking triumph. We have had workouts which were much better and some which were poorer. It is typical of our bread and butter type of operation. We attempt to obtain all facts possible, continue to keep abreast of developments, and evaluate all of this in terms of our experience. We certainly don't go into all the deals that come along. There is considerable variation in their attractiveness. When a workout falls through, the resulting market value shrink is substantial. Therefore, you cannot afford many errors, although we fully realize we are going to have them occasionally. Dumpster mill manufacturing. This situation started as general in 1956. At the time, the stock was selling at $18 with about $72 in book value, of which $50 per share was in current assets, cash receivables, and inventory, less all liabilities. Dumpster had earned good money in the past but was only breaking even currently. The qualitative solution was on the negative side, a fairly tough industry and unimpressive management, but the figures were extremely attractive. Experience shows you can buy 100 situations like this and have perhaps 70 or 80 work out to reasonable profits in 1 to 3 years. Just why any particular one should do so is hard to say at the time of purchase, but the group expectancy is favorable whether the impetus is from an improved industry situation, a takeover offer, a change in investor psychology, etc. We continued to buy the stock in small quantities for 5 years. During most or this period, I was a director and was becoming consistently less impressed with the earnings prospects under existing management. However, I also became more familiar with the assets and operations, and my evaluation of the quantitative factors remained very favorable. By mid-1961, we owned about 30%, or Dempster. We had made several tender offers with poor results, but in August and September 1961 made several large purchases of $30.25 per share, which, coupled with a subsequent tender offer at the same price, brought our holding to over 70%. Our purchases over the previous 5 years had been in the $16 to $25 range. On assuming control, we elevated the executive vice president to president to see what he would do unfettered by the previous policies. The results were unsatisfactory, and on April 23, 1962, we hired Harry Bottle as president. Harry was the perfect man for the job. I have recited his triumphs before, and the accompanying comparative balance sheet speak louder than any words in demonstrating the reemployment of capital. Cash. For November 30, 1961, $166,000. For July 31, 1963, unaudited, $89,000. U.S. government securities at cost, $289,000 for July 31, 1963. Other marketable securities at market which exceeds cost, $2,049,000 in July 31, 1963, with total cash and securities of $166,000 on November 30, 1961, and $2,436,000 for November 31, 1963. Accounts receivable, $1,040,000 for November 30, 1961, $864,000 for July 31, 1963, inventory of $4,203,000 for 1961, and $890,000 for 1963. Prepaid expenses, etc., of $82,000 for 1961 and $12,000 for 1963, with a total current assets of $5,491,000 for 1961 and $4,202,000 for 1963. Other assets, $45,000 for 1961, $62,000 for 1963. Net plant and equipment of $1,383,000 for 1961 and $862,000 for 1963. Total assets, $6,919,000 for 1961 and $5,126,000 for 1963. Notes payable, $1,230,000 for 1961. Other liability, $1,088,000 for 1961 and $274,000 for 1963. Total liabilities of $2,318,000 for 1961 and $274,000 for 1963. Net worth, $60,146 SHS November 30, 1961, $62,146 SHS July 31, 1963, with $4,601,000 for 1961 and $4,852,000 for 1963. Total liabilities and net worth of $6,919,000 for 1961 and $5,126,000 for 1963. Harry, 1. Took the inventory from over $4 million, much of it slowly moving to under $1 million, reducing carrying costs and obsolescence risks tremendously. 2. Correspondingly freed up capital for marketable security purchases, from which we gained over $400,000. 3. Cut administration and selling expense from $150,000 to $75,000 per month. 4. Cut factory overhead burden from $6 to $4.50 per direct labor hour. 5. closed the 5 branches operating unprofitably, leaving us with 3 good ones, and replaced them with more productive distributors. 6. Cleaned up a headache at an auxiliary factory operation at Columbus, Nebraska. 7. Eliminated jobbed lines tying up considerable money which could be used profitably in securities while producing no profits. 8. Adjusted prices of repair parts, thereby producing an estimated $200,000 additional profit with virtually no loss of volume. And most important, 9. Through these and many other steps restored the earning capacity to a level commensurate with the capital employed. In 1963, the heavy corporate taxes were facing Harry surprised me by the speed with which he had earned up our tax loss carry forward, coupled with excess liquid funds within the corporation compelled us to either in some way deincorporate or to sell the business. We set out to do either one or the other before the end of 1963. Deincorporating had many problems, but would have in effect double earnings for our partners and also eliminated the problem of corporate capital gain tax on Dempster securities. At virtually the last minute, after several earlier deals had fallen through at reasonably advanced stages, a sale of assets was made. Although there were a good many wrinkles to the sale, the net effect was to bring approximately book value. This, coupled with the gain we have in our portfolio of marketable securities, gives us a realization of about $80 per share. Dempster, now named First Beatrice Corporation, we sold the name to the new company, is down to almost entirely cash and marketable securities now. On BPL's year-end audit, our First Beatrice holdings were valued at asset value with securities at market less a $200,000 reserved for various contingencies. I might mention that we think the buyers will do very well with Dempster. They impress us as people of ability, and they have sound plans to expand the business and its profitability. We would have been quite happy to operate Dempster on an unincorporated basis, but we are also quite happy to sell it for a reasonable price. Our business is making excellent purchases, not making extraordinary sales. Harry works in the same way I do. He likes big carrots. He is presently a limited partner of BPL, and the next belt-tightening operation we have, he's our man. The Dempster saga points up several morals. 1. Our business is one requiring patience. It has little in common with a portfolio of high-flying glamour stocks. During periods of popularity for the latter, we may appear quite stodgy. It is to our advantage to have securities do nothing price-wise for months, or perhaps years, while we are buying them. This points up the need to measure our results over an adequate period of time. We suggest 3 years as a minimum. 2. We cannot talk about current investment operations. Such an open-mouth policy could never improve our results, and in some situations could seriously hurt us. For this reason, should anyone, including partners, ask us whether we are interested in any security, we must plead the Fifth Amendment.